market is a little skeptical, as they should be. But that jump really hinged on the economic data, especially the manufacturing data that came out that was really weak, and that's what kickstarted this. So for me, it almost doesn't matter when they lower rates, and that will kickstart gold, I believe, and it could trickle down into the juniors and shift sentiment. We're above $2,100 now. I have said that if we can stay above that level and sustain that and not fall back down to 2,000 or below, that could be the beginning of a shift in our market.
JeffClark, the founder of Pay Dirt Prospector, is predicting a potential paradigm shift that could undermine the stability of the US dollar, hinting at the emergence of a new currency. He offers 5 compelling reasons to maintain a bullish outlook on gold. Amidst this backdrop, the price of gold has continued its rally, surpassing $2,180 and reaching fresh all-time highs of nearly $2,200 during the early Asian session on Monday. Clark attributes this surge partly to the prospect of the Federal Reserve implementing interest rate cuts, which supports the yellow metal. Furthermore, ongoing geopolitical tensions have heightened the safe haven demand for gold. Clark points out an expectation that the Federal Reserve may opt to lower interest rates sooner than previously anticipated, driven by weak economic indicators. Historically, during easing cycles and rate cuts by the Fed, gold and silver prices have tended to rise. Although the possibility of a May interest rate cut by the Fed has climbed to around 30%, the June policy meeting remains the most likely expected timing for any such move, as indicated after a crucial jobs report. Clark underscores that recent jumps in gold prices have been triggered by weak economic data, particularly in manufacturing sectors. This highlights the significant influence of economic indicators and Fed policy decisions on short-term movements in gold and silver prices. Citigroup stated it could soar to $3,000 per ounce in the next 12 to 18 months. It is stated that all of this depends on 3 possible catalytic factors: major central banks worldwide significantly increasing gold purchases, global stagflation, or if there is a deep global recession, gold prices could rise by about 50%. As gold enters a bullish consolidation phase, oscillating in a narrow band below the $2,200 mark, Clark identifies a specific price level, $2,100, which, if maintained, could signal a bullish shift in market sentiment. Join us as we explore JeffClark's insights. Stay updated by subscribing to our channel and activating notifications. Thank you.
Gold has risen almost $40 2 days in a row. After Friday's big rise, I thought the gold price was going to cool off on Monday, today, and it did just the opposite. So there's some momentum there. It's probably some short covering. It's probably some speculators jumping in. But the kickoff of that was real. The economic indicators came in and they were weak, meaning the Fed, the market thinks the Fed will likely lower rates sooner than what they said. So whether or not that's true, we really should look forward to the Fed eventually lowering rates, and that's kind of what kickstarted this, and we'll see if it continues. The first reason has to do with the Fed, and I hate the fact that we have to look at the Fed and rely on the Fed to determine what the gold price might do. But in the short term, this is what is happening now. Because they might lower rates sooner than expected, gold jumped. If you go back to the last 11 times there's been an easing cycle with the Fed, and they've lowered rates, 9 of those 11 cycles, the gold price rose. Gold stocks, even in the last 3 rate lowering periods, gold stocks rose like 218% on average. Silver rose over 400% on average in the last 3 lowering cycles. So there's a lot of historical evidence that says, hey, when the Fed does lower rates, that is going to kickstart something in the gold and silver market and the equities.
Why else be bullish gold? Make the case for gold.
I think there's another silver thing we should look at. There's a lot of things happening in the silver market. I put them all together in some charts. Basically, mine supply is falling. It's in a major downtrend. Total supply is in a major downtrend. And of course, as many viewers know, silver demand is actually rising. So you have falling supply, rising demand. What does that mean? We have a deficit. We had that big deficit 2 years ago. This year, it's projected to be another major deficit. If you add up all 4 years of the silver deficit, it's 2/3 of a billion ounces of silver. in 4 years that we are in deficit. That's not a small number. If you view gold and silver as money, you're more likely to buy it. If you just view it as a metal, you're less likely to buy it. So if you view it as money, start to look at that and view it that way.
That's how you view it.
That's how I
It's
view it.
sound money for you.
It's sound money, but I mean, it's also the traditional argument. It's insurance. It's a hedge. It's protection against monetary issues, crisis. I think people at home have been saying that for a while. I think the market is a little skeptical, as they should be. That jump really hinged on the economic data, especially the manufacturing data that came out that was really weak, and that's what kickstarted this. So for me, it almost doesn't matter when they lower rates, and that will kickstart gold, I believe, and it could trickle down into the juniors and shift sentiment. We're above $2,100 now. I have said that if we can stay above that level and sustain that and not fall back down to 2,000 or below, that could be the beginning of a shift in our market.
The United States has reached a significant milestone, with its national debt surpassing $34.4 trillion, marking a troubling trend of increasing debt accumulation. This staggering figure reflects an alarming growth rate, with the debt expanding by approximately $1 trillion every 100 days. Such rapid escalation has sent ripples of concern throughout financial markets, prompting serious inquiries into the nation's long-term fiscal well-being. Further exacerbating the situation, credit rating agency Moody's Investors Service recently revised its downward outlook on U.S. government debt. This downgrade comes amidst continued struggles with high levels of government spending, notably highlighted by sustained robust military expenditure, which has accounted for 9.3% of GDP over the past 4 years. In response to these unsettling developments, experts like Clark advocate for the ownership of gold as a prudent strategy. Gold serves as a hedge against economic instability, particularly in the face of unsustainable debt levels. Additionally, Clark underscores the importance of owning physical gold to mitigate counterparty risk, emphasizing its tangible security amidst uncertain financial landscapes. Let's get back to the interview.
Do you have to believe in the dollar's demise to be bullish gold is the question?
No. That's a big picture reason. I think that'll eventually happen. I don't think that's going to happen tomorrow, but that's a reason the monetary system is going to have to shift because our debt load is unsustainable. Everybody's seeing the charts on the interest payments on our debt. That's not sustainable. Biggest spike in the history of them keeping records. They can't pay all that. They're probably going to create currency to do that. That's going to weaken the dollar even more. Long-term, big picture, yes, you should be in gold because of that. The population is not growing that fast. GDP is not growing that fast. So the growth in that is not.
When that breaks, what does that look like, Jeff?
It could be very ugly. And I think that's another reason to own gold, and not just own gold, but make sure you own it in physical form. I mean, I hate to say it could get really ugly, but I do think that's a possibility. It's not because I want to use it to barter with. I mean, that would be an extreme scenario. Let's hope we don't get there. I want it because it's going to protect me against all these issues, and I don't want counterparty risk. That's the big thing for me. I do have some in storage, so there's some counterparty risk there, but I want physical within my immediate grasp because I don't want counterparty risk. I don't want to have to rely on another party, a bank, a fund, an institution, a CEO who ran off. I don't want any of that. That's why I own physical. At some point, I think sentiment's going to shift back into our sector. And when that happens, honestly, Danielle, I'm going to see some very easy doubles and triples with the miners. I think that's going to happen. There will be some money made. So I'm positioning now. And my biggest fear is that it happens too soon or so quickly.
Yeah.
I'm not as positioned in as many stocks as I want to be. That's a real thing for me. So we're looking at a lot of things now. Bitcoin ETF has now surpassed assets under management, the silver ETF. It just passed it today. So that move is real. People are buying that. But look at the demographic. You have to. Most people buying Bitcoin are on the younger side. Most people that are in gold are old guys like me. So I think there is a demographic issue to that. But Bitcoin was rising while gold was rising. So that tells me that the two are separate, at least to a degree. So I'm not too worried about that.
There is palpable anticipation that the Federal Reserve will ease monetary policy, prompting investors to reassess gold's role as a hedge. Recent data from the Commodity Futures Trading Commission reveals that, as of February 27th, the proportion of net long positions in gold has surged to its highest level in 3 weeks. This resurgence has enabled investors to fully recover from recent lows and adopt a bullish stance on gold as a safe haven asset. How do you evaluate the likelihood and impact of these catalytic events on gold's value? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.